From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Welcome to the HPS Macrocast. My name is Matt McDonald. I'm joined, as always, or most of the time I'm not even here. But I'm joined today by John Fagan and Brendan Walsh from Markets Policy Partners. It's Friday, October 4th. ISM, market reaction, Fed, impeachment, trade, and hot off the presses today, jobs. I do not know how we are going to work through all of the news this week in a half an hour, but
we'll talk fast like auctioneers.
We are going to do our best. Let's start with the jobs numbers. So I am looking at the HPS jobs fact sheet, hot off the presses. This was a good jobs number. It was 136, which is it's lower than, say, like the trailing 12-month type of stuff. But at this point in recovery, that's kind of the amount of workers that you can get out of the economy.
Yeah, I think it should be about 150, so it's within spitting distance.
Yeah. Unemployment rate is at a 50-year low at 3.5%, which is we'll talk about an environment where we're talking about Fed policy and 3.5%.
Yeah, 1969 was the last time it was at 3.5%.
And yet we're talking about loosening. And then the other piece on jobs report that we've obviously been watching for a long time is that the wage numbers are good too, 2.9% increase year over year. That's all pretty strong stuff. We also saw revisions up in July and August. So those 2 months were kind of cranking around the 160 range. So
yeah, we got 45,000, 7,000 in July, so we're at 166, and then August was up a total of 38,000, so 168. So we kind of freaked out last month that it was low. Though you do have to. There was a lot of census workers, so 25,000. So the real number is more like 140, 145.
So ending the week on a nice note with a pretty solid jobs number that kind of keeps the at least the real economy cranking.
Yeah. Especially the unemployment rate, which is the household survey. That was incredibly strong because that also shows the number of unemployed and employed. So the number of unemployed was down 257,000. So there's about 5.8 million unemployed people in America, which is quite amazing. The number of employed was also up. I have that 391,000, which is pretty amazing. And my kind of favorite indicator of how the health of the economy is doing, especially the job market, is within that report. It's job losers, so people that got laid off for whether you screwed up or whether it was downsizing. So that was down 304,000 people. And then job leavers, so someone that's doing well and I'm going to go get another job or start a company. That was up 59,000,
which is a sign of strength.
Exactly.
Yeah. So, but let's talk. Let's put. So this is good number and good data. Let's put it in context. John, can you run through the rest of the week that was across the market?
Well, this came at not only was it a nice number, but the relief factor was even higher, given that we've had a string of really disappointing numbers earlier in the week. And so even though expectations for this number were 145,000 and this slightly missed, this was, the rest of the report was obviously glowing, the upside revisions. Everybody just breathed a sigh of relief after seeing the dire ISM, which is the Institute of Supply Management's purchasing managers indexes for September in the manufacturing and service sector space. The manufacturing gauge came out on Tuesday morning and was really what set everything off in terms of the sell-off this week. Brendan, what happened with this with the manufacturing number? It fell off the table.
Yeah, and it was really across the board. So the ISM was at 50.1. So anything above 50 denotes that sector is in expansion. Anything below it's contraction. And we came in for September at 47.8, and the last time we were there, was back in the depths of the kind of the crisis.
Yeah, that is like a deep contraction in activity.
Yeah. If you're around 50, it's not great, but it's not anything to freak out about. Going below 50 means people are cutting. And when you look at the sub-indices, it was kind of terrible across all sectors. And then later in the week, the same company, Institute of Supply Management, does the non-manufacturing sector, so the service sector, which is even more important for the United States. I mean, we're not really a manufacturing economy anymore. And that really surprised people with how weak it was. So we were at 55, which is really strong. And that was kind of where people weren't totally freaking about the trade war and the effect on the economy, as long as the service sector is doing 5. And that came in at 52.6.
Yeah.
Where we're kind of expecting it to stay flat at 55.
I feel like the trade war context for all this, there's measured expectations around what manufacturing and ag are going to be able to do in that, with those headwinds in that environment. But as you say, it's a service-driven economy,
and it's about 10% of the economy. So we can survive that, but we can't survive a slowdown in the service economy.
Right, that's right.
And that was it obviously shocked the equity markets. There was a sense this year, we've talked about it before on this podcast, that the Treasury market and the equity market have been on different planets for most of the year. The Treasury market has been, moving in ways that are very consistent with a slowdown, if not an actual outright recession. We've talked about the yield curve inverting, and for periods of time, and that being the traditional harbinger of upcoming recession with some sort of lag. But meanwhile, the equity market has just been, been hitting new highs. As recently as late July, it put in a record peak, and it just has bounce back ability in the face of a lot of these negatives. And so we saw this sort of forehead slapper moment when the manufacturing PMI, and it really took that kind of huge downside shock. We've had some wobbly U.S. data, but the equity market has been able to just ignore it, whereas the Treasury market has basically continued to foretell ongoing deterioration, a weak outlook, that sort of thing. But it was the quantum of disappointment was impossible for even the blissed out equity market to overlook. And U.S. equities fell pretty precipitously over Tuesday and Wednesday, losing 3% over 2 sessions. It was a pretty big fall. There was other stuff going.
It was actually one of the worst starts to the fourth quarter ever.
Yeah.
I mean, it's somewhat arbitrary, it's day, but it does matter to Wall Street.
Yeah, and we didn't obviously see a big, huge concurrent move in treasuries rallied, but it wasn't that big a move because they were already kind of positioned for that. They already saw this coming. Yeah. And the dollar, which usually moves higher in a risk-off scenario, they get safe haven inflows, and people take flight to quality, flight to the dollar. The dollar actually behaved a little bit differently during the sell-off in the middle of the week because investors were paring their bets on the expectation for continued U.S. economic outperformance. So the dollar backed off, but it backed off, pretty close to multi-year highs. It's been pretty strong.
It's such an interesting moment across all these dimensions. We're talking about Fed loosening policy with a 50-year low in unemployment. Mm-hmm. You've got dynamics in markets around the world where you have global slowdown that is impacting some of this stuff. You have we talked a little bit about WeWork and some of the kind of IPO reassessment of tech and where that stuff is. It's just there's so many different signals heading in so many different directions that it's really interesting to try to sort through these pieces.
That's absolutely right. And I think taking a step back and looking at the disparity of where the Treasury market is and the signals that is giving off, and where the equity market is, as divergent as those two narratives are, that put them together, and that's a classic late cycle formulation. Mm-hmm. Equities at all-time highs and an inverted yield curve. We've seen this movie before. We saw it in 2007.
And we've had a decade of low rates, but also quantitative easing. So that has kind of the amount of treasuries that the rest of the world is able to buy has been decreased because central banks own so much of it. So the whole point of quantitative easing is to push people out on the risk curve. And over the course of 10 years, there's less and less good things to buy. So then money finds its way into kind of silly things. And WeWork, I think, is a very good. I mean, everyone uses WeWorks and everything like that, but they kind of give it to you for free. And WeWork is basically the largest real estate holder in basically every large city in America, and now we're getting to the world. And it's a real estate company. It's a REIT. But it has a tech valuation, and that's classic. it's almost the point of quantitative easing to push money into risk, and like John said, that's what happens when we get to the end of a cycle. Not saying tomorrow is the end of we're going to recession, but this is just classic, late innings.
Yeah,
behavior.
It is interesting to look across all of the quote unquote tech companies that have pushed into the real economy that can be understood on some element of private markets subsidizing consumption across different sectors on the basis of market capture or what have you, and it's completely unclear how any of these shake out, and a lot of the IPOs have been sucking wind.
And another example of that is Robinhood. So Robinhood was an online broker that gave it away for free, and they had a nice little niche, and they sold it to we're going to take over the world. Well, this week Charles Schwab, the largest broker in the world, has about $3.7 trillion in assets. They cut their commissions to zero also, and then E-Trade and Ameritrade had to follow. Fidelity's probably going to. So now, what's the business proposition for Robinhood?
Right.
And I think it's still a private company, but it went from basically a $10 million company to now about $7 billion valuation at the last round. I would imagine that after this week, it's not quite at $7 billion.
Right. Yeah. That rush to IPO has that also sort of last call at the bar feel to it.
Yeah.
When all these big companies that everybody were thinking, well, when are they going to go public? Well, they're going to go public when they don't think when they think the valuations might be tippy toppy. Yeah. That could be part of their thinking. Certainly in the past we've seen, some classic. It's always impossible to call the top, but if you're an insider and in the know, we saw Glencore, the commodity giant IPO, like about a day before the huge commodities top in 2011. We saw Blackstone IPO in 2007, which was gave people sort of that. The hair stood up on the back of their necks when they said, "Oh, the smart folks at Blackstone have just cashed out." And Goldman Sachs didn't quite hit the bullseye with their IPO in '99, but they got out ahead of the tech bubble popping. And so there's it's not a law of nature or anything like that, but big IPOs tend to have that.
Yeah, and we work. I mean, it worries me a little bit at the margin. Actually, J.P. Morgan is now trying to save them, but we actually have a sovereign nation that's IPOing with Saudi. That one worries me a little bit if that doesn't go well.
I mean, basically, if you're IPOing Aramco, as soon as everyone heard that they were IPOing Aramco, when they realized that they were actually serious about doing it, instantly a lot of people thought, wow, they don't think that they're going to get all this oil out of the ground. They're trying to.
I mean, it's not like there's political instability in the Middle East or anything, right?
That's a good point.
So taking it from markets then to Fed and Fed reactions. So where's the Fed been this week? What's the sense of their plays going forward?
Well, we've had a decent amount of Fed speakers come out this week, but they haven't really given us that much to hang our hats on. It's been a lot of the same kind of mantras. Fed Vice Chair Clarida was out last night, and he repeated that mantra of "we'll act as appropriate." Fed speakers have generally been pretty upbeat about their assessments of the U.S. economy, trying to downplay one week's worth of bad data, and kind of sticking to the script. There's been, between Kaplan, Evans, New York Fed President Williams. Kaplan is Dallas Fed president. Evans is the Chicago Fed president. There's been some diversity of opinion on display in the comments this week. So there really hasn't. The market has basically been on its own and taking the data and using that to give them the guide as to what the Fed is going to do. So during the middle of the week, when the data
on some level that is a choice by the Fed to let the market absorb the data and take with it what they're not trying to.
And this year, the market has basically made Fed policy.
Yeah, there's a sense that the market's going to make up their minds for them, and we saw the rate cut odds for the late October meeting, which had been about 50-50, about a coin flip going into this week, go up to about 90%. The the really Goldilocks-y non-farm payrolls number has pulled that down, but certainly not all the way back down to 50. It's around 75% the last time we looked. And the odds of a fourth consecutive rate cut in December are still pretty lofty as well, almost like a 50-50 or slightly below that.
Yeah. Which is amazing, too, because when they did the first cut, they kind of hoped that could be it.
Right.
And now we're talking about maybe getting 4 cuts in 2019, when in January of 2019, the market was still talking about 4 hikes.
Right. So, I mean, Powell, when the first cut came out, that was framed as kind of mid-late cycle, let's tweak, we're just kind of managing it.
Yeah.
That's not where we're at anymore.
I don't know. Is 4 cuts a tweak, John?
That's no tweak. That is a easing cycle, and that's not all. The market is pricing in further cuts in 2020.
More important.
So there was obviously, when Fed Chair Powell said those words about a mid-cycle policy adjustment, the market obviously wavered a little bit, but then basically said, we beg to differ, and the market basically began to set its own policy trajectory that the Fed has since
and where are rates now, and how much room do they have as we look ahead at an easing cycle? What does that dynamic look like coming up?
Oh, so right now the Fed has cut. They started at the top range was 2.5%. They've cut 25 basis points, 0.25% twice. Mm-hmm. So the top end of the range right now is 2%. The bottom end of the range is 1.75%. And the expectation is that 2% is going to be, as low as 1.5% at the end of this year. So, and that is that's a pretty swift cutting cycle.
So, and how much are the markets thinking about that? How much room the Fed has to negotiate this, and like how short is the runway that they have to land this plane on?
Yeah, it's the traditional formulation if you assume we're late cycle and we're going into a slowdown, typically the Fed tends to be behind the curve. The Fed starts cutting, the market breathes a sigh of relief initially, but the economy continues to slow, and the Fed starts cutting with more urgency as things go, as the economy slows further. That's this, and then markets react pretty badly in the later rate cut environment, just because nature's already taking its course with the economic slowdown, and the Fed hasn't gotten ahead of it. This easing cycle is a completely different animal, because at the end of the rate cut rainbow is the pot of gold of quantitative easing.
Right. Mm-hmm.
And that is something that's in the back of the mind of every equity investor, certainly every investor around the world in every asset class. Quantitative easing, which are asset purchases by the Fed, which bulk up their balance sheet and take risk. Basically, it's an extreme easing tool. The European Central Bank just re-engaged their quantitative easing program. And this is something that is, this is why we saw a rebound yesterday after we got the lousy purchasing managers index in the service sector. The equity market was down over 1%, and then immediately turned tail as the focus shifted to, now the Fed is really going to start giving us some free candy here.
So that sets up the grand question of whether Jay Powell will be playing the role of leprechaun down the road. But we also are looking at a whole host of political shocks in the U.S. system and trade talks that are contextual to all of that stuff. Let's take a quick break and then come back and talk about some of those pieces on the board.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
Okay, we're back. Let's turn our eyes from the markets to Washington a little bit, if you can bear to look at it for an extended period of time. But there's obviously been a sea change in kind of the political dynamic in Washington. Impeachment is very much on the table. I would say that at this point the Democrats have to go through with it in the impeachment process in the House. The Senate is a much different question, but it's obviously going to impose a huge distraction and a lot of paralysis on Washington and the policymaking apparatus over the coming months, and then you've got the election coming up behind it. I mean, this is where the end of season 1 of the Trump show is going to land. How are the markets looking at some of the chaos that we're seeing down here?
So right now, the market, which actually I think is probably correct, and it's one of the rare times where the market and the DC kind of folk probably actually agree, where they think that the House, Pelosi will put it to the impeachment vote. It'll go to the Senate and it'll die because they have the votes there. So unless within these new investigations and subpoenas, something new, a totally smoking gun happens, I think you're in the situation where it'll be noise, and on a day-to-day basis, things can go up and down. But we really haven't seen it fully priced into the market.
Yeah. The thing, putting on my political hat for a second, the thing that people, I think, are looking at here is, what does his approval rate look like?
Yeah.
What does his approval rate look like in the states that have senators who will be voting on this, and what happens there? Because there's not a sense, and I think that this is right, there's not a sense that there's a deep well of personal relationships that he can draw on in the Senate that will save him,
right,
if it comes to that. And to be honest, I'm not sure that even if he did have it, it matters. Impeachment on some level is a very political process,
Yep.
and you got to look at the numbers and the public polling and all that sort of stuff. And so that's the thing that I think people are looking at, is like, look, if his numbers get bad enough and people would rather be in the lifeboat than on the ship, then he goes down. That's what happens. And then the second question going into that is a little bit of a question of, okay, we have this bifurcated media environment right now,
Yeah.
where people are reading and talking only to their own people. And so there's this element of, on the right side of the media apparatus, is that support hold, or does that start to crack? And that's probably the forecast of what might happen in the polling, which then is the forecast of what happens in the Senate. But I think from a political perspective, that's how people are looking at the environment around this coming up.
Yeah, when we listen to, obviously, the folks on Wall Street are not political experts, and so they're well informed and certainly well connected, but they don't necessarily know the machinery the way people in DC do so intimately. And so when there is discussion about the potential for President Trump to be removed from office, which, as you said, as Brendan said, most people on Wall Street think is pretty vanishingly low, tail risk at this point. But, anything could happen, and they try to jump a few moves ahead.
Anything could happen.
Right.
That is
really could happen.
That is a good starting point for understanding any of the current environment.
When market participants jump a few moves ahead on the chessboard in that scenario playing out, they typically say things like, President Pence doesn't worry me at all. There's a sense that maybe he's on the margin a little more hawkish on China than people expected. Maybe he's a little more hawkish on the Middle East. Who knows? But essentially, most people on Wall Street say there's pretty much policy equivalence between a President Trump and a President Pence. The idea of what this would do to the 2020 election picture is, I think,
it's a little far away for the market now.
As we said last week, it's pretty far beyond the investable horizon for a broad swath of market participants. Yeah. Although we did see, they're still trying to handicap these, the odds as we go, and we did see the news about Senator Sanders' heart procedure early this week. Certainly got some play on trading desks, and the commentary was obviously, if he's going to have to drop out, or his supporters, they're going to basically, everybody on Wall Street sort of took his support and put it in Elizabeth Warren's camp and sort of played that out.
I'm not saying that all the prospective candidates, including the sitting president, are old, but you could do worse than looking at actuarial life tables for the political season ahead in the campaign. I mean, it's and anything could happen.
So that's certainly right. And the sense, obviously, on Wall Street is Wall Street gets a little weak in the knees when they think about Elizabeth Warren. They're worried about her regulatory, her regulatory posture. And there's certainly, there tends to be some, political bias on Wall Street. So it's something that we'll watch this space but there's plenty. There's a lot of time left in the primary process, and so
there's a lot of time until the votes are cast. I mean, there's a lot of speculation at this point.
Yeah, so you get that distinction that we talked about last week, that sort of headline reaction, but once that dies down, markets can't keep it in mind.
I'm curious on one score that there's different discussion around different policies that have been of topic in D.C. In one main one being the drug pricing bill and focus on that. Was there any reaction on drug companies on the market in terms of the impeachment distraction is going to change how the Congress or the president are either going to be able to work together or pass any legislation or anything like that? Did you guys see anything there?
I didn't pick up anything on that front. We've had enough noise in the markets where it's a little bit hard to tease out.
That's that's a fair point. It's always interesting to there's a dimension of Washington where it's there's a lot of people, but collectively people can only pay attention to so much at one time, and the center stage right now is the impeachment drama.
Yeah, and that's another narrative that I think Wall Street has correctly picked up on in terms of the Trump administration, that they are a one-issue administration. They don't really have the bandwidth to do 4 or 5 things.
Well, when you have one guy making all the calls,
it's hard to make. Yeah. So Wall Street almost is maybe taking a potential impeachment process as a positive, because then it takes away the drug issue. It takes away it puts potentially a China deal on the table also.
Yeah. So let's take a break and come back and talk about China. China's obviously, they've been dragged into the Biden inquiry stuff with Trump this year, but we've also got the trade talks on the table. So let's talk a little bit about that after we come back.
Markets Policy Partners provide sophisticated financial market analysis that is independent, accessible, and actionable for a broad audience. Learn more at marketspolicy.com.
All right, so we're back. China. So we've got impeachment drama on the home front, and Trump has artfully inserted that into the China dynamics as well. On the China side, you've got drama over there too. You've got Hong Kong. You've got their 70th anniversary that Trump kindly observed, which caused some heartburn in his party. And then we've got trade talks coming up. So what's the sense of where that's going to land, and what does the context for that look like going into it?
Yeah, I think the market is definitely putting high odds on sometime in the fourth quarter that we get the mini deal. And I don't necessarily think they care whether it's actually real or not, but at least it puts the scariness of considerably higher tariffs and escalation off the table. So I think people are expecting that we'll make some concessions on Huawei or something like that, and they'll buy more soybeans, and then we'll move ourselves into the 2020 election.
Yeah, the October 15th tariff increase is I think it's the $250 billion of Chinese imports, and the tariffs on those are already at 25%. The October 15th they're scheduled to ramp up to 30%, and then that is, that's something that wouldn't be necessarily welcome for markets if that comes through, if they're not able to get a mini deal before that. But the showstopper would be the December 15th set of tariffs, which is focused much more on the consumer, consumer-facing goods.
Yeah, it would a nice little holiday present.
Thank you. Merry Christmas.
Yeah, and they were put off to. They were originally scheduled to go on earlier as part of a larger application of tariffs, but they were actually delayed. And as we remember, the Trump administration announced that they were delayed so as not to have an impact on consumers during the holiday season. despite the fact that no consumers are paying for these tariffs, right?
Yeah, it does have this quality of, when you think about Trump and Trump deals, is that the ability to sell it as a successful deal is almost as important as the quality of the deal itself.
I totally agree, yeah.
And I do wonder about, as this drags on, as you have impeachment here, as you've got kind of different economic signals coming up, is that it does have this feeling of kind of he's getting into a little bit of a corner on the trade stuff, and I'm not sure which way that cuts in terms of likelihood of a deal or less likelihood of a deal, or it does have this quality of like, if there's a deal, there's going to be a broad sense that he had to, and I'm not sure that makes him more likely to cut one.
Yeah, where this deal will be a weak deal. It'll be from a position of weakness, and because your polling numbers are going down, the economy is weakening. That's why you cut this deal. But I think people always kind of just expected whatever the deal is, as you talked about the media being divided and his base kind of loving himself, and he's actually very, very good at selling it. So I think there is a belief that whatever it is, he can sell it as a win.
And we've gotten some good questions from some of our clients.
He probably believes it.
Yeah, he totally believes it. Yeah.
We've gotten some very good questions from some of our clients and other contacts about whether the Chinese might take this opportunity to really stick it to President Trump, and he's under extreme domestic political pressure, and if they walk away from the table next week and really leave him hanging out to dry, and the markets have a terrible time with it, then they can maybe ensure that he's a one-termer. And I just don't think that is what the Chinese calculus. That's totally inconsistent with the way that the Chinese have been relatively restrained in these. The escalations have come from the U.S. The Chinese have been looking to, have tended to de-escalate, although they've responded in kind partially. They certainly, there are lots of levers that they haven't pulled. And if they were really going to go, great guns and try to cut President Trump's knees out from under him, they probably would have done it.
And from
already.
what we hear from the China experts that we talk to, China's assuming that Trump wins. So that wouldn't make any sense to.
I feel like a lot of that stuff is projecting fundamentally U.S. views onto what China should do, and not really from a Chinese perspective of what China should do.
And I think that's definitely a weakness, and a weakness in the market, where our analysis is entirely U.S. centric, and we're not doing the market isn't doing a China view.
I mean, that is the air we breathe. It's just very difficult to actually pull yourself out and have a perspective from the other angle. It's just very difficult. Yeah. All right, what else are we looking at in the week ahead?
So it's more of a quiet week, but we have two important inflation data points with the producer price index, which is the rate of inflation that is at the producer level, and then we find out how much that inflation gets passed on to the consumer later in the week with the consumer price index. And the CPI is important in terms of Fed decision making. The indice that they track is the personal consumption personal consumption expenditures index, which comes out later in the week. But that index incorporates a large amount of the actual data from the CPI. So there has been a disconnect between the two measurements. So the core CPI, which measures, it takes away the kind of more volatile food inflation, and that's what the food and energy, and that's what the Fed focused on. For the CPI, it's been running at 2.4%. So the Fed targets 2%. So that's been above. And the PCE, core inflation index, is only at 1.8%. So that is, from a historical perspective, a large kind of gap. But a lot of the experts that look at the kind of the details, the big discrepancy has been in the healthcare components, and the two do it slightly different. And the CPI healthcare has been running above what the PCE has done. Mm-hmm. So people are kind of more expecting the CPI to come down to the PCE rather than the other way. But at a minimum, the PCE was at 1.4% earlier in the year when Chairman Powell talked about these deflationary forces being transitory. So he was right about that, and we're kind of climbing towards potential 2%.
To bring it full circle, we talked about the jobs report at the top and 2.9% wage growth year over year. I mean, that's really strong. So how closely is the Fed watching that dynamic in terms of inflation and wages as they're trying to calculate where the economy is actually going to land?
So we will find,
So it seems like the runway's getting shorter.
No, definitely. But that brings me to the other big event for next week is the minutes of the September meeting. So there we get a much more detailed discussion of what happened at the meeting, what the focuses were. So that might be something we find out.
Yeah, and Fed Chair Powell has explicitly downplayed the strength of the U.S. labor market as something that is going to upset their loosening cycle. He talked about the non-inflationary, the neutral rate being much lower than the neutral rate of unemployment being now much lower than they had initially thought, and so that's why we've seen a lot less impact from non-farm payroll numbers on markets because markets don't think the Fed is really keying off of it.
Yeah. All right, we're going to have to leave it there for this week. Thank you for joining us on the HPS Macrocast. You can tune in again next Friday to see how the rest of this story plays out.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.